Hello traders, my name is John. I'm the founder at Hooked Up Trading. In this video we're going to be discussing a few different option strategies. We'll start out really simple and then get to a little bit more complex strategies, and we'll also discuss how each strategy varies based on risk-reward ratio. First up, we're going to talk about the single option strategy. This is the most simple. The single option strategy doesn't necessarily mean that you're only buying one contract. It means that you're only buying one type of contract. There are two different ways to do this. You can be long calls or you can be long puts. And that simply means that you either buy a long call contract or you buy a put contract. If you were to buy the call contract, it gives you the right to buy 100 shares of the underlying stock at the strike price on or before expiration. You would purchase a call contract with the expectation of the contract value increasing, and for the contract value to increase, the share price would have to increase. This would be a long position in the company's share price with added leverage on your investment, and the maximum loss on this trade is the cost of your contract. To be long puts is very similar, except the put contract gives you the right to sell 100 shares of the underlying stock at the price on or before expiration. You would purchase the put contract with the expectation of the contract value increasing. However, unlike the call contract, the put contract value increases with the decrease in share price. So this could be seen as a short position on the company with leverage added to your investment. And again, the maximum loss is the cost of your contract. Next, we're going to talk about share replacement. This is a specific type of single option strategy that allows you to be long or short on company share price. If you're long on the company, you would purchase a deep in the money call. And personally, I prefer delta between 0.81 and 0.89 on these trades. And this gives you the benefit of leverage over a larger position than you could buy if you were purchasing shares. The high delta will cause the contract premium change to be similar to the change in share price, and that gives you the ability to capture most of the gain with much less starting capital. And just like the other single option strategies, the maximum loss is equal to the contract premium that you pay to enter the trade. And if you're short on the company, the idea is very similar. You would purchase a deep in the money put. My preferred delta is above 0.84 for these trades, and it gives you the benefit of entering a short position without having to use margins. And it also gives leverage over more shares than you could if you were shorting shares. And just like with the calls, the maximum loss is equal to the contract premium that you pay to enter the trade. Next, we're going to talk about vertical spreads. You can enter into the strategy with calls or puts as well. To do this with a bullish thesis, you would purchase a call contract, usually at the money or in the money, and then you would sell a contract with a higher strike price, usually out of the money. Contracts purchased are the collateral necessary you need for the contract sold, and a debit will be deducted from your account to enter the trade. To do this with puts is very similar, except you would want to have a bearish thesis on the underlying stock. You would purchase a put contract, usually at the money or in the money, and then you would sell a put contract with a lower strike price, usually out of the money. The contract you purchased is collateral necessary for the contracts that you sold again, and a debit will be deducted from your account to enter this trade. Now, whether you're using this with calls or puts, the maximum loss on these trades is equal to the cost of the contract purchase less the credit collected from selling your out-of-the-money contracts, and your maximum gain is equal to the difference in contract strike prices less the debit paid to enter the trade. Entering into a vertical debit spread, it really just takes a little bit of risk off compared to a single option strategy. When you sell the further out of the money strike contract, it just is a small hedge against your bet just in case you end up on the wrong side of the trade. You immediately get some of the capital back from the contract that you sold, but it also limits your potential gain. Up next, we're going to talk about vertical credit spreads. These trades are interesting because you actually get paid to enter the trade. Just like all the other option strategies, you can enter into one of these trades with calls or puts. The idea would be to sell a call contract and purchase a call contract with a higher strike price. Collateral is required to cover costs between strikes on these trades. For example, to sell a $50 strike call and buy a $52.50 strike, the collateral required would be $250, and a credit would be collected to enter the trade because you're selling the contract with the lower strike price, and that's going to be more expensive than the one that you purchase. The maximum loss is the spread between strikes less the credit that you collect for entering the trade. It's important to keep in mind that this is a bearish trade because you're selling the lower strike contracts, so you're actually shorting the contracts. So you're betting against share price on this trade. You can also enter this with puts, and you would sell a put contract, and then you would purchase a lower strike put contract. Collateral is required to cover the cost between strikes, just like with the calls. If you were to sell a $50 strike put and purchase a $47.50 strike put, the collateral required would be $250 as well. A credit would be collected for entering the trade. Since the higher strike put is the one that you're selling, it should be more expensive. And the maximum loss on this trade is also the difference between strikes less the credit that you collect for entering. And here it's important to have a bullish thesis on this trade because you're shorting the puts. If share price falls too far, then you begin losing on this trade. The simple but effective day trading strategy for options is a strangle. The idea is to purchase a call and a put contract equidistant from the share price. You really just want to make sure that both of your contracts cost about the same amount. And then you cut the loser fast and you let your runner run. This requires disciplined trading on technical indicators because you can potentially lose both of your contract premiums if the share price trades flat and positions are not closed before expiration. So you do want to be really careful and really disciplined with these trades and make sure that you're taking profits and cutting losses within a specific amount of time as well as at your specific levels. If you're familiar with options, you know that holding them through earnings is one of the most dangerous types of trades. Using an earnings strangle takes some risk off the table, and you can do this whether you're long or short on the underlying stock. If you're long on the underlying stock, you could purchase an at-the-money call and an out-of-the-money put. The put would act as a hedge on your actual thesis just in case, and you do have the expectation of increase in share price. Your maximum potential loss is the cost of both contracts, but your maximum potential gain is uncapped. Um, the purchasing the out of the money put gives you a hedge that just allows you to lose a little bit less if you end up being wrong if share price goes the opposite direction, but the volatility is still there. If you're in the trading group, you've actually seen this with Twitter. The thesis was bullish on the underlying stock, and we used the earnings strangle. The stock went the wrong way, but we actually ended up being profitable because the volatility through earnings was still there, even though we were wrong on what we had expected to happen. Um, if you're short on the underlying stock, you can purchase an at the money put and an out of the money call. And with this, you would expect a decrease in share price. And again, the maximum loss is the cost of both of your contracts. And again, purchasing the out of the money call is just a hedge against your original thesis of being short on the underlying stock. All right, I hope you learned a little bit about some different option strategies and maybe you'll be able to put some to use for some successful trading in the future. Our top trade idea for next week and going into the next month is going to be Intel. We're really bullish on the stock right now with the new CEO and good earnings coming out last quarter. We've got a lot of good forward guidance coming out and think we should be seeing a good move, especially with the semiconductors being hot in general. We're going to be looking just at a single option strategy and purchasing a 57.50 call for February 19th or March 19th, depending on how much risk you want to take on. I think the move will happen kind of quick, but getting that extra month won't be that much more expensive, and it'll give you a lot more time for the trade to work out. Support confirmation, we're looking at flat levels at 54.6 and 53.4, and we're also looking at a breakout above the next level up at 56.1. And then because there's so much time on this trade, we're going to wait for a breakdown below the next level for the stop loss. So we'll let it break down below 53.30 before we actually look at exiting the trade for a loss. And the profit taking levels are going to be kind of high. We're looking for 58.30 to 59.50 for taking profits on this trade. That's all we got for the video today. I hope you found some of the information useful, and good luck on your trading going forward.